As of June 2023, you need about $150,000 invested into JEPI to make on average $1,000 a month in dividends. This video is a few minutes long. Obviously, there's more to the story for people that don't just have $150,000 lying around. For regular people that are trying to build these positions, stick around to what you need to know. JP Morgan has $3.7 trillion and 26 billion of those dollars are in one single ETF. That ETF is JEPI, or the JP Morgan Equity Premium Income ETF. Now, you might have heard about this ETF because of its massive monthly dividend potential, and the higher the dividend, the less money you need to invest to make $1,000 a month from a single ETF. Currently sitting at an 8% dividend yield, investors earned 36 cents per share owned based on the June 1st, 2023 dividend, and in the past, monthly dividend payouts have been as high as 61 cents per share. But with any high-paying dividend stock or ETF, before we put our hard-earned money into it, the question needs to be asked and answered, is this a dividend trap? A dividend trap is a stock or an ETF that offers a high dividend, but the actual price of the asset continues to fall over time. You might be getting a yearly, quarterly, or even monthly passive income, but overall the value of your investment is going down over time. Basically, you're getting paid to lose money. But in some situations, if you have these assets in a taxable account, you can actually pay money to lose money because the dividend counts as taxable income. And you're gonna have to pay taxes to the IRS because they always get their cut. The US market historically has a general tendency to go up in value over time. So the simplest comparison I've come up with is to match up an asset against the performance of the S&P 500, which is considered the benchmark for performance. JEPI was created in May of 2020, and if you invested $10,000 and reinvested the dividends, overall you'd have $14,420.57 in June of 2023, which gives us an annual return of 12.69%. If you invested the same $10,000 in SPY over the same time period, you would have $15,559.62, which is an annual return of 15.5%. So we clearly see that from a dollars in, dollars out perspective, the benchmark S&P 500 outperformed JEPI, but I wouldn't consider this a dividend trap because it technically did go up in value. But because JEPI seems to pass my very basic tests, that doesn't mean it'll continue to do so in the future, so make sure to keep an eye on it. All right, but focusing on the important part, JEPI did make money over the past 3 years, but not as much as the S&P 500. Why would anyone buy this if they could just buy the benchmark, which is seen as safe and made more money overall? Well, JEPI's strategy involves writing options on stocks that the ETF owns to generate a premium, not just waiting for the companies to pay dividends. So this premium is why the ETF's dividends are so high. This is for people looking for monthly cash flow, not necessarily overall returns. You can actually do this yourself with your own holdings as long as you own 100 shares of a stock. This has its own risks for individual investors, and JP Morgan is just doing this through an ETF, which gives us part of the profits if we own it. And this is one of the reasons I love covered call ETFs, because they do the work for me so I'm not risking my other positions, and I can focus on other things, like this YouTube channel. So if you're enjoying the video, click that like button and subscribe for more content. Now, covered call ETFs in general have two major disadvantages. One is that they're not tax efficient because most, if not all, of the dividends aren't qualified. And two is that they limit upside potential, which means that if the market goes on a massive bull run, the fund won't go up at the same rate because of the option strategy. Now, even after I told you it didn't perform as well as the S&P 500 in the past 3 years, even after I told you it's not tax efficient, even after I told you it has limited upside, and even after I remind you that I'm not a financial advisor, this is not financial advice, and you should speak to a professional who knows your exact situation and can help you get to your financial goals. If you still want to buy JEPI with the intention of making $1,000 from it every single month, here's how much you'd need. Now remember, JEPI doesn't pay a regular dividend. It does pay monthly, but the amount it pays out changes. Don't worry, the math can still be worked out to give us an estimate on how much JEPI we would need to get $1,000 in passive income. $1,000 a month is the same thing as saying $12,000 a year, and JEPI has a current dividend yield of 8%. And those two numbers are all we need. $12,000 in dividends per year divided by 8% expressed as a number, which is 0.08, gives us a nice even $150,000. Notice I never said how much JEPI was trading for because it doesn't matter in terms of calculating how many dollars you actually need invested. How much money we get from a dividend stock or ETF is dependent on how much money we put in and what the dividend yield is. JEPI as of July 22nd is trading at around $54.75, and if you bought $150,000 worth, you'd end up with around 2,739.726 shares. Okay, don't be discouraged. Now, $150,000 was a lot lower than I thought it was going to be, but realistically, most people, including myself, don't just have $150,000 lying around. Most of us have to build a $150,000 position in a JEPI with regular monthly investments. The simplest way I found to estimate how long it'd take to build up a $150,000 position is to use this calculator from Dividend Athlete. These next calculations assume regular monthly payments on our part that don't take into consideration taxes, inflation, the price of JEPI changing over time, and assume a stable 8% yearly dividend and reinvesting those dividends. Now, I know that's a lot of assumptions. That's kind of the point. We want to keep this simple because there's a lot of unknowns and no one knows the future. These are estimates to help guide us in the beginning, and then over time we can make adjustments as new information comes out. So from the calculator, if we invested an initial $1,500 and contributed $1,200 a year or $100 a month for 30 years, we'd end up with over $158,853.55 after reinvesting our dividends. We would have invested $36,300 of our own money over that same time period, and in return we get a large gain, but also $12,174.31 in yearly dividends, or $1,014 a month. If we increase the contribution to $2,400 a year or $200 a month, we end up with $301,303.51 after reinvesting our dividends for 30 years. In this scenario, we put $71,000 of our own money, and if we increased our contribution to $6,000 a year or $500 a month, we end up with $728,653.38 after 30 years. We put in $175,500 of our own, but that gives us $55,842.94 in yearly dividends, or $4,653 a month. So clearly, if we increase our monthly investment, we make significantly more money. But what if we increased our starting amount? If we increased our starting amount to $2,000 and we kept the same $1,200 a year contribution for 30 years from our first calculation, we'd end up with $160,321.42. That's an additional $5,467.87 from simply starting with $500 or more money. That's an additional $5,467.87 just by starting with an extra $500, or a 10x on your additional dollars. So clearly, starting with more money means we're going to make more money in our scenario. So the takeaway from the math is invest as much as you can, as early as you can, and as often as you can, and hope that everything works out, because returns aren't guaranteed. Now, I know what you're thinking, Raj, I have a lot of stuff going on, this is too much math, and I can't be bothered to invest for 30 years, I got stuff to do. All right, I get it. But what if we just want to set it and forget it? How much money would we need over 30 years to get to 150K without putting in any more money into the position or giving it a second thought? If you invested $14,000, had an annual dividend of 8%, reinvested those dividends, and never touched it, you would end up with $153,100.22 at the end of 30 years, letting compound interest work for you. That gives us $11,733.38 in yearly dividends, or $977 a month. So pretty close to $1,000. $14,000 as a lump sum sounds much easier than $150,000 as a lump sum. Before we get too ahead of ourselves, having a ton of money in one ETF that's only been around for 3 years might not be a great strategy. That just sounds risky. My opinion is that 99% of people are better off investing in their retirement accounts for the long term in safe, stable assets like the S&P 500. But if you're willing to take the risk, JEPI might be an extra source of income for you in the future. But if we're planning on actually investing in JEPI for 3 decades, we want to make sure that the JEPI is at least a legitimate investment. Here's a quick overview of the ETF of what we didn't already cover, so you can use this as a starting point for your research into JEPI. JEPI is an ETF that is seeking consistent premium income with lower volatility, and to deliver monthly distributable income and equity market exposure with less volatility. It has a total of 136 holdings, and as of June 21st, 2023, its top 10 holdings include Adobe, Microsoft, Amazon, Hershey, Accenture, MasterCard, Pepsi, Comcast, Progressive, and Coca-Cola. Going further into the holdings, you'll see something called equity link notes. This is not the easiest thing to explain, but the simple explanation is the fund will lend money to a financial institution, and they will then invest that money into equities and options. The financial institution can guarantee the principal will be safe, but any profits are usually split. We don't have access to the full terms of these ELNs, so that is an unknown risk for the ETF. So some upside, although limited, but some protection too, assuming those financial institutions don't go bankrupt. That is an incredibly simple version. A video from the channel Value for Investors has really great info on ELNs specifically for JEPI, and I'll leave a link in the description down below. Now, as far as sectors of the market are concerned, JEPI's current holdings make it heavy in tech and industrials as well as healthcare, and the consumer defensive sector and financial services. It has light exposure to consumer cyclical sectors as well as utilities and communication services, and very little exposure to basic materials, real estate, and energy. So I wouldn't say JEPI is balanced, but I wouldn't say it's imbalanced either, and I don't think this ETF is a one ETF solution for most investors. So let's recap. There are a few ways to get to $1,000 in monthly dividends using JEPI, having $150,000 and buying it all in one lump sum, starting with $1,500 and investing about $100 a month over 30 years and reinvesting your dividends the entire time, or invest $14,000 initially and reinvest your dividends for 30 years. And those last two are based on a lot of assumptions. Hopefully this video gave you a little insight to JEPI and the power of compound interest and made you aware that $1,000 in monthly dividends is certainly more attainable than most people think, once you expand your timeline, of course. Thanks for watching. Be sure to subscribe for more money, finance, and crypto content, and if you found value in the video, click that like button, and see you in the next video.